In this review, you will unlock the secrets behind the creation of a global financial dynasty by delving into Ron Chernow's The House of Morgan. This blink uncovers the intricate history of the Morgan banking empire, revealing its origins in the mid-19th century. Explore how this powerful dynasty not only withstood over a century of economic turbulence, legal hurdles, and regulatory changes but also navigated the complexities of family connections, wealth, and substantial influence. Discover the compelling narrative of the Morgan family, whose legacy has profoundly shaped the course of global finance and endured the challenges of evolving times. 1830 to 1860, the emergence of the House of Morgan in the financial landscape. Amid the vibrant financial milieu of 1830s London, where esteemed institutions such as Barings and Rothschild and Sons wielded considerable influence, George Peabody rose as a pivotal player. His mission, transcending the confines of individual state debt, was to renegotiate the financial obligations of debt-laden American states. This task, far beyond personal interests, positioned Peabody as an ambassador not only for Maryland but also for the overall financial credibility of the United States on the global stage. George Peabody's journey from modest beginnings to financial prominence was deeply influenced by the shadows of personal adversity, shaping him into a man of unwavering frugality. In a strategic move in 1837, he defied conventions by establishing a merchant house in London, a departure from the prevailing trend of London banks dispatching representatives to the burgeoning American financial landscape. The 1840s brought forth a series of defaults by American states, casting a shadow over the nation's financial reputation. In the face of this challenge, Peabody, profoundly impacted by Maryland's debt struggles, committed himself to the monumental task of restoring faith in American securities. His resolute efforts during this tumultuous period underscored his character, revealing a man resilient and resolute in times of crisis. As Peabody's wealth burgeoned, he turned his attention to philanthropy, while his personal life remained shrouded in mystery. The search for a successor culminated in a transformative partnership with Junius Spencer Morgan in 1854, a pivotal event marking the genesis of what would evolve into the House of Morgan. The fortitude of the Morgans faced significant tests during turbulent times, including the 1857 panic. However, these financial upheavals were not merely challenges. They were opportunities that sharpened the Morgan family's banking strategies and resilience, laying a robust foundation for their eventual dominance in the financial landscape. Junius Spencer Morgan, architect of a timeless financial legacy. Can the principles and vision of a singular individual truly resonate across generations, shaping an entire sector for over a century? The resounding answer lies in the legacy of Junius Spencer Morgan, the patriarch whose methodical strategies and unwavering temperament laid the cornerstone for the enduring influence of the House of Morgan. The question that beckons is, what distinguished Junius, leaving an indelible mark not only on his family but on the global financial stage? Unlike the archetypal rags-to-riches narrative, the Morgan saga unfolds as a tale of sustained affluence and prosperity spanning multiple generations. This foundation of stability and privilege became the crucible for their distinctive approach to both business and societal engagement. But how did this unfold? The son of Junius and Juliet, John Pierpont, J.P. Morgan, was nurtured in a lap of luxury, receiving a comprehensive education that traversed the landscapes of Europe. His early foray into finance was marked by speculative trading during the tumultuous Civil War. Yet, Pierpont's personal life was not immune to challenges, marked by health issues, a complex relationship with his father, and the poignant tragedy of his first wife, Amelia Sturgis. The profound impact of this loss set a stark contrast to his subsequent stable marriage to Frances Louisa Tracy. In shaping Pierpont's trajectory, Junius played a pivotal role. He provided a stabilizing force by orchestrating Pierpont's collaboration with Charles H. Dabney, resulting in the formation of Dabney, Morgan, and Company. This strategic move positioned Pierpont to perpetuate the enduring banking traditions of the Morgan family. The Morgans ascended to prominence during a transformative era in banking, characterized by the expansion of railroads and heavy industries. In this pivotal juncture, Financial titans like the Morgans wielded considerable influence, often dictating terms to both trade and governments. Adhering to the Gentleman Banker's Code, a set of customs emphasizing discretion and a passive client acquisition approach, the Morgans secured and maintained an enviable and influential position in the realm of finance. The 1907 financial crisis. John Pierpont Morgan's pivotal intervention. As the ominous shadows of financial turmoil loomed over the stock market in late October 1907, heralding a looming disaster, John Pierpont Morgan emerged as the linchpin in preventing the collapse of the American financial system. A convergence of factors, including stringent monetary policies, President Roosevelt's critique of affluent players, and speculative investments in copper and railroad stocks, collectively triggered the Panic of 1907. A stark revelation during this crisis was the vulnerability of trust companies, entangled in risky ventures without adequate cash reserves. In a strategic move, P. Morgan orchestrated a coalition of bankers, persuading them to pool resources and redirect capital to avert the impending catastrophe. His influential role extended to securing a substantial loan from the U.S. Treasury, injecting much-needed liquidity for market stabilization. At the age of 70, Pierpont effectively assumed the mantle of America's de facto central bank. His interventions played a pivotal role in restoring confidence in the financial system, preventing the onset of a severe recession or depression. While undeniably successful, Pierpont's actions triggered apprehensions about the concentration of financial power within the hands of one individual. The irony of his efforts lay in safeguarding trust businesses, which had historically clashed with Wall Street's established banking sector. However, their fragility during the crisis underscored the imperative for a more stable and regulated financial landscape. This critical juncture propelled momentum for banking reform, ultimately culminating in the establishment of the Federal Reserve System. This monumental shift marked a departure from private financial bailouts towards a paradigm of government-led economic oversight. The House of Morgan in the crucible of World War I. The summer of 1914 ushered in the cataclysmic onset of World War I, a period of unprecedented turbulence and financial jeopardy. The House of Morgan, a stalwart in the financial realm, found itself thrust into the epicenter of this chaos. As Austria-Hungary declared war on Serbia on July 28, the reverberations sent shockwaves through Wall Street, already grappling with a bear market and the looming specter of recession. Stepping into this maelstrom was Harry Davison, a key figure at the House of Morgan. Recognizing the gravity of the situation, the Morgans orchestrated a strategic move, rallying Wall Street's titans to shutter the New York Stock Exchange. The objective? To avert a potentially disastrous market crash. This tumultuous period witnessed the ascendance of the United States as the world's leading creditor nation, marking a seismic shift that signaled the decline of England's financial hegemony. Initially contemplating a role as mediators for peace in the Balkans, the Morgans pivoted their strategy as the war unfolded. Their pivotal role involved coordinating and financing the Allies' procurement of war materials, commencing with a staggering $12 million acquisition of horses. Ultimately, the House of Morgan supervised approximately half of all American supplies sold to the Allies, amounting to a staggering $3 billion. Yet, the Morgans' wartime involvement was not without controversy. Accusations of profiteering, favoritism, and perceived closeness to British interests fueled charges of disloyalty and undue foreign influence. Despite these challenges, the family's unwavering commitment to the Allied cause persisted, rooted in their ties to England and a steadfast belief in the mission of the Allies. If you discover even a hint of value in our content, we'd be truly grateful for your support through likes, shares, and subscriptions. It's surprising that 88% of our listeners haven't engaged yet, so I kindly ask for your support. Your comments are not just a guiding star but also the foundation of our progress. Thank you. Now, let's delve back into the review. The House of Morgan's Metamorphosis in the New Deal Era, 1933 to 1938. Transport yourself back to a pivotal juncture in financial history, where the reverberations of the Glass-Steagall legislation sent shockwaves through Wall Street. Faced with a decisive choice between deposit and investment banking, the House of Morgan stood at the precipice of transformation. As hopes for the repeal of the Securities Act of 1933 dwindled amid the progression of New Deal reforms, the financial titan found itself navigating uncharted waters. The Securities Act, a landmark legislation, ushered in a new era by mandating the registration of new securities and demanding complete transparency from companies and underwriters. This shift from a «buyer beware» to a «seller beware» paradigm presented a formidable challenge to the House of Morgan, renowned for its discreet operations and unparalleled influence. The intrigue deepened in 1934 when the House of Morgan, in tandem with Richard Whitney, the president of the New York Stock Exchange, vehemently opposed the Securities Act. Their objective was to staunch the tide of escalating financial regulation. Despite their formidable efforts, the act prevailed, marking a triumph for proponents of oversight and a setback for the traditional powerhouses of Wall Street. Internally, within J.P. Morgan & Company, a sense of frustration permeated, particularly among partners like J.P. Morgan Jr., commonly known as Jack, who grappled with the acceptance of this new political and economic reality. A pivotal moment arrived in 1935 when the House of Morgan reached a crossroads. Opting to preserve J.P. Morgan & Company as a deposit bank, they simultaneously gave birth to Morgan Stanley, a distinct investment banking entity. This strategic decision, influenced by Depression-era market conditions, the imperative to retain a substantial workforce, and the potential for future reintegration, carried significant implications. Across the Atlantic, Morgan Grenfell, the British arm of the House of Morgan, embarked on its own transformative journey. Evolving into a limited company partially owned by its New York counterpart, Morgan Grenfell fortified its authority, reshaping the dynamics of transatlantic finance. Functioning as a custodian of the House of Morgan's securities underwriting legacy, it aligned itself with the evolving regulatory landscape. As the House of Morgan set its course, the unfolding chapters of time would ultimately unveil the wisdom or pragmatism behind these pivotal decisions. Alliances, antitrust, and adaptation. The resilience of Morgan Stanley in the 1950s. Step into the tumultuous 1950s, a decade of upheaval for Wall Street, where one entity stood resilient against the storm: Morgan Stanley. Despite its relatively modest size, this investment bank had swiftly asserted itself as a trendsetter, exercising formidable influence over major corporations. Operating discreetly but effectively, Morgan Stanley built a close-knit network of partners and personnel, positioning itself as an unparalleled force in the financial landscape. Morgan Stanley's clientele boasted an array of industrial heavyweights, with the investment bank wielding unquestionable sway over these corporate giants. Fortune 500 companies sought their expertise, contributing to the firm's unassailable dominance. The question arises: what was the secret behind Morgan Stanley's ascendancy? Rewind to the era of the Glass-Steagall legislation, which mandated the separation of investment and commercial banking. Despite this division, an unexpected alliance flourished between J.P. Morgan & Company and Morgan Stanley. Collaborating closely, they directed business towards each other and even shared facilities. Morgan Stanley became synonymous with luxury and high standards, steering clear of political entanglements and focusing solely on business operations. Their conservative approach to client selection and a cautious attitude toward market fluctuations solidified Morgan Stanley's position as the undisputed king of investment banking, while J.P. Morgan & Company maintained its roots in commercial banking. In the late 1940s, the U.S. Justice Department launched an antitrust attack against 17 investment banks, including Morgan Stanley, accusing them of monopolizing underwriting. The legal battle unfolded over several years, ultimately reaching Judge Harold Medina. However, the judge found no evidence of illegal collusion among these firms. The post-World War II landscape brought further disruptions to the financial industry. Cozy relationships between companies and their bankers disintegrated due to structural market changes, compelling investment banks like Morgan Stanley to adapt to a more competitive and diverse financial landscape. How did Morgan Stanley navigate these challenges? With a focus on blue-chip clients and a cautious approach to new ventures, the investment bank retained its crown as the epitome of investment banking. Meanwhile, the House of Morgan encountered fresh obstacles as the 20th century progressed, setting the stage for the next chapter of their journey. The 1980s, Morgan Stanley's evolution under Reagan's influence. The Reagan era ushered in a transformation on Wall Street, resembling the speculative fervor of the 1920s. Characterized by surging stock markets and tax cuts, this period masked the United States' declining economic position against Japan and Europe. While the stock market's boom didn't enhance U.S. competitiveness or reduce trade deficits, it fueled global borrowing. The trading culture underwent a significant shift, attracting the nation's brightest minds to a more fervent and macho-driven financial sector. This period witnessed a departure from genteel Wall Street as profit-driven young executives took charge, often overlooking broader political and social concerns. In 1985, Morgan Stanley experienced a pivotal transition under the leadership of Eric Gleacher in the Mergers and Acquisitions division. Gleacher's approach to acquisitions surpassed established methods, reflecting a broader trend on Wall Street where investment bankers pursued deal-making beyond client wishes. Morgan Stanley's new strategy involved scrutinizing every deal for profit potential, participating in significant transactions such as the Revlon acquisition and playing a busy role in high-stakes corporate takeovers. These practices mirrored the 1980s when investment banks spearheaded global market integration. However, the emphasis on self-enrichment raised concerns about capital mismanagement and the financial health of American firms. A crucial development during this period was Morgan Stanley's foray into leveraged buyouts, LBOs, often financed by junk bonds and bank loans. These deals burdened corporations with substantial debts, leading to asset sales and cost-cutting measures. Morgan Stanley's involvement signaled its transformation from a conservative broker to an aggressive financial player. The reforms of the 1980s had both positive and negative implications for Wall Street and the overall economy. While the loosening of regulations fostered innovation and rapid development in financial companies, it also set the stage for future financial disasters due to a lack of oversight. The stormy aftermath of the Reagan Revolution reflected the double-edged nature of these reforms. The enduring legacy of the House of Morgan. The House of Morgan, spanning a century of financial influence, didn't merely shape their family's destiny but left an indelible mark on the entire financial industry. Their narrative unfolds as a saga of global financial dominance, marked by astute business decisions, a commitment to philanthropy, and a strategic blend of both conservative and aggressive banking practices. This legacy extends beyond the realms of finance, influencing broader social and political landscapes, making the House of Morgan a cornerstone in the evolution of modern finance. Thank you for returning and staying with us until the end, reflecting your commitment to progress and wisdom. In return, I kindly ask for a small favor. A simple act of liking, sharing, subscribing, and commenting would be immensely appreciated. Your support helps the channel reach a broader audience and, consequently, grow. As a token of gratitude, I'll continue delivering book reviews from some of the most impactful books in the world. Thank you.